China is one of the world's largest creditors. While it once focused primarily on buying the government debt of developed countries, over the past 20 years, China has shifted its attention toward lending to developing nations. What's especially interesting is that these loans are often tied to China's broader strategic goals. Rather than simply earning interest, Beijing uses overseas lending to expand its political influence and advance its economic interests, from securing access to natural resources to creating new markets for Chinese companies. In this video, I'll explain what debt trap diplomacy is, how it works, and why many analysts believe it has become one of China's most powerful foreign policy tools. The basic idea behind debt trap diplomacy is surprisingly simple. China offers a developing country a loan to finance a major infrastructure project, a highway, railway, port, or power plant. The loan is usually approved with fewer political conditions than financing from institutions like the IMF or World Bank. However, there's one important catch. The project is typically built by Chinese contractors using Chinese equipment, Chinese materials, and often Chinese labor. To understand why this matters, let's first look at how international trade is usually financed. Imagine an exporter receives a large order from overseas. Even though they'll eventually get paid, they still need money up front to buy raw materials, manufacture the product, purchase equipment if necessary, and pay employees. To cover these costs, the exporter typically takes out a loan from a commercial bank. The downside is obvious. The exporter is responsible for paying the interest, which reduces their profit. There's another possibility. Instead of the exporter borrowing the money, the foreign buyer can obtain financing through a bank in their own country. But that arrangement also has complications. The buyer may pay only a portion of the contract up front and require bank guarantees in case the exporter fails to deliver. In other cases, payment may not arrive until after delivery. Either way, traditional export financing usually requires one of the parties to rely on commercial banking, adding both costs and financial risk. To solve this problem, governments developed a financing mechanism known as buyer's credit. Under this system, the exporter's bank lends money directly to the foreign buyer. The importer becomes responsible for repaying the loan, but the money never actually reaches them. Instead, it is transferred directly to the exporter, allowing the project to move forward immediately. These programs are usually administered by government-backed financial institutions, such as export-import banks or export credit agencies. For example, in the United States, this role is performed by the Export-Import Bank of the United States. In the United Kingdom, it's UK Export Finance. China has its own Export-Import Bank of China. Many countries use buyer's credit to support exports in key industries. The U.S. Exim Bank has historically financed a significant number of aircraft exports, particularly those involving Boeing. UKEF has supported major British exporters, including companies in the defense sector such as BAE Systems. South Korea's export credit institutions have played a similar role in supporting companies like Hyundai. China, however, has taken this model much further. Instead of using buyer's credit simply to support individual export deals, Beijing has turned it into a cornerstone of its global economic strategy. The scale is enormous. Chinese policy banks, including the Export-Import Bank of China and the China Development Bank, have financed hundreds of billions of dollars in overseas infrastructure projects. A large share of this financing has been associated with the Belt and Road Initiative, China's flagship international infrastructure program. According to the China Global Investment Tracker, investments connected to the initiative total hundreds of billions of dollars. Many developing countries welcome these loans because they often come with fewer policy conditions than financing from Western-led institutions. If a government wants to build a railway, port, or power plant, Chinese financing may be available much faster and with fewer demands for economic reforms. This approach has helped China become one of the largest bilateral lenders to many countries across Africa, Asia, and Latin America. Of course, many of these loans carry significant financial risks, and not every project will generate enough revenue to repay the debt. But from China's perspective, maximizing financial returns may not be the primary objective. The broader goal is strategic. Economically, overseas infrastructure helps secure reliable supply chains. improve access to raw materials, and create new markets for Chinese exports. Politically, lending can increase China's influence over debtor countries. Critics argue that governments facing heavy debt burdens may become more willing to make political or economic concessions. These concessions can include granting Chinese companies long-term leases on strategic infrastructure, awarding government contracts to Chinese firms, opening domestic markets, or providing access to valuable natural resources. China strongly rejects the term debt trap diplomacy and argues that its overseas lending promotes economic development and mutual cooperation. Regardless of where you stand in that debate, one thing is clear. Chinese overseas lending is about much more than finance. It has become a central component of China's foreign policy, allowing Beijing to expand its economic and geopolitical influence around the world.